Hi, welcome to this video where we're going to talk just briefly about intangible assets. Intangible assets end up on your balance sheet for a couple of reasons. You either buy them or you create them, but generally if you create them, you're not going to capitalize them. For the most part, you're not going to capitalize them. Some of the most valuable intangible assets, they don't show up anywhere on a balance sheet. And the reason being is that they're really hard to determine the value for and to kind of put your hands on. And so we generally only see them on the balance sheet during an acquisition, but there are a few cases that we would see them on a balance sheet, and so we're going to talk about them in this video. So these intangible assets are assets that are lacking physical substance. They include items that involve exclusive rights, such as patents, copyrights, trademarks, franchises. Accounting for the intangible asset depends on how it's acquired. It's purchased in a situation other than business combinations, meaning a whole business. Is it developed internally, or if it's acquired in a business combination? So either buying one patent. So you buy one patent, that is buying an intangible asset, but that's very different than buying a business that has a whole bunch of patents. And we account for those two things a little bit differently. And then the ones developed internally. Noting the two differences here under IFRS and US GAAP. Generally expensed when it's incurred in our business. So if we have something we're researching, we're investing in, we're trying to figure out, and it is an intangible in nature, just trying to learn as an organization, trying to figure things out, they'll usually be expensed, generally. Under IFRS, expenditures on research are expensed, and under IFRS, expenditures on development are capitalized. Research is expensed, and development is capitalized. So there's a certain process that you get to, and you're gonna have more questions about this, I know. First of all, how do you define research and development? For this class, research and development will be clearly identified in any problem you see. What you need to know is that the difference in understanding the line, it's not like a very clear line where research turns into development, but generally research is going to be about exploring and discovery, and development will be about taking a nugget of knowledge and growing it and fixing it and making it better. Under US GAAP, generally both research and development costs are expensed. We say, look, they're just expensed, all right? Yeah, you might have value there, but you don't get to put it on your balance sheet. And then for costs related to software development, so products for sale, both research and development are expensed until there's a technology feasibility, and then it is capitalized. If it becomes feasible that something's going to happen from this, there's going to be future expected economic benefits from having this, then they'll be subsequently capitalized. The expenses will be capitalized. Remember, they don't get valued at like the new value for the discovery, they just get capitalized, the expenses. And then for software, if you create some sort of software, scheduling software for internal use, some of you might work at organizations that have had to get like specific PeopleSoft coding for using, as a CRM. There might be something with Oracle that you have to program yourself. Any customized software for internal use, both research and development expenditures are expensed until probable completion is demonstrated, all right? And then they're subsequently capitalized. So if it's for internal use, software for internal use, that's what we do. So that's the difference in between those two. And let's look at a quick example. Let's assume this company incurs expenditures of $1,000 per month in the fiscal year ending December 31st, 2019 to develop software. And this software is going to be for internal use, all right, under US GAAP. What is the accounting impact for the company being able to demonstrate that the software met a criteria recognition as an intangible asset on February 1st versus December 1st? Okay, so now go ahead and pause this here and look at this question and then think, okay, well, what is the point of asking this? Why are we even talking about this? Okay, you probably can figure out what the difference is, but pause right here and see if you can think of the point. Well, the point is that when you determine this, feasibility can matter, and there's a lot of discretion. Managers get to decide some of these things. And so if we have these expenditures and it's related to this and there's some uncertainty, if we decide that, you know what, we actually, we could probably capitalize. If we decide we've read some feasibility here and we're going to actually capitalize it at the end of January. Well, you'll notice we only will have $1,000 of expense on our income statement. And so you can see how if a manager wants to say not expense something in a given period or have more expense in a given period, you can see how this might become a tool for manipulation. So generally, we're very conservative when it comes to, even internationally, we're very conservative when it comes to you developing your own technology and how we're going to value this internal technology, because we don't want people gaming it by expensing or not expensing and capitalizing or not capitalizing it based on the needs of what they have as a manager, as opposed to what is the practical reality of what's going on, because there's discretion here. You're allowed to decide. All right, so here's the three different things, and we talked about this a little bit when we talked about assets. All right, so other intangible assets in our last class. So as a summary, intangible assets that are purchased in situations other than business combinations, meaning they're not part of a business, what we do is we record at the fair value, which is assumed to be equivalent to the purchase price. All right, and we treat it just like picking up a tractor or a factory or something like that. We record it at the price we pay. Intangible assets that are developed internally, we generally expense those when they're incurred, although we capitalize in some situations. Some situations we capitalize, and we went over that. Intangible assets that are acquired in a business combination, well, that's when we go through the process we talked about related to the balance sheet. We get all the identifiable assets, tangible and intangible. So factory equipment, land, in addition to patents, in addition to a brand. And what we do is we come to a valuation for all of those things. We determine what the value is, and then we compare it to the original purchase price. And the net difference is an asset that we call goodwill. And what do you remember about goodwill? There's nothing good about goodwill a lot of times. It's the only thing we know for sure that's in there is overpayment. So that's all the assets in there, and goodwill becomes an asset. All the identified assets go on the balance sheet, and that's how assets get valued. Intangible assets get valued and capitalized.